Hello, and thank you for joining us. I'm Wendy Falk, and I'm here with Stewart Willis of Asset Preservation, Tax and Retirement. Stewart, it's great to be back with you.
It has been a great one, Wendy.
Yes, it has. How are you doing today?
I'm doing wonderful.
Good. You ready to get the show started?
Let's do it.
Okay, let's do that. You know, Stewart, we've got a lot of things going on, and this is the number one question that people ask all the time. Where are we in the market?
Well, you know, whether we're high or low right now, it's really hard to tell. We're seeing some just incredible volatility. I mean, a lot of people right now we're seeing take some pretty irrational positions, believing they're waiting for the market to come back, for example. And I think what we try to do is help clients take a 30,000 foot view of where we actually are, and who's to tell 20 years from now where we are. But right now, understand we've just experienced a decade-long bull market. It's been incredible. And yes, we're down from where our peaks were, but we're still up substantially. And so when we see a lot of clients, we're making recommendations for some people that just couldn't tolerate the risk to maybe take some risk off the table. And we see a lot of people that are actually waiting for it to come back. And we try to put into perspective exactly where we are. So we're still high relatively. I think there's a lot of room for correction, but hopefully it's not too bad there.
How are you guiding your clients through this time in our history?
Well, I think communication is key. Thank goodness we haven't seen the kind of volatility and loss in our portfolios that most of America has. We have a couple different parts of what we do. We have a market division, and we have a fixed insurance division as well. And all of those sides make up an entire portfolio. The market obviously saw some declines, but we have a tactical approach to things where we aren't just sitting waiting to take it. A lot of advisors put into place a 5-position mutual fund portfolio or a 10-position, and they just let it sit there. And every quarter they rebalance, and to them, that's their asset management. Well, we take a much more tactical approach to things. So we got, the first week got us a little bit, and then we shifted tactically into a very defensive posture. The question is when to get out of that defensive posture, right? When to really capture the gains. At this point, it's kind of hard to tell with all of the volatility if it's time yet. But we've taken a very defensive posture, so we're a lot less susceptible to the volatility that a lot of advisors have seen.
And that's what makes you all at Asset Preservation and Tax Retirement unique and such wonderful advisors. And you also tell us a little bit more about the fact you actually have a tax planning department within your company. Is that correct?
That's right. So we have a tax office. Most tax offices, some of the big box tax offices, are seasonal. That you show up, they shut down, after tax season's over, April 15th, they're done. Well, this year's a little different, obviously, because of the July 15th extension. But we have a year-round tax preparer in our office. This season, we had 2 CPAs, an enrolled agent, and a certified tax preparer doing all the preparations. Preparation is just about filing taxes. That's just about entering a few numbers that are on your 1099s, your W-2s, your K-1s, and it is what it is, right? The magic happens with the tax planning. The tax planning is key. I would always say, if you hear people on the radio that are advertising, hey, we'll save you taxes, give us your tax returns, I'm sure you didn't take these deductions. We're very by the book when it comes to tax planning or tax preparation, but when it comes to tax planning, we try to think outside of the box to really make sure that people realize that we are in this amazing opportunity right now. We are in the lowest tax situation we've seen in history. And it's a really opportune time to really do some planning here, right? Nobody believes that taxes are going to get any lower than they are now. We're hoping, but it's very unlikely because of the situation we found ourselves in here.
Yeah, and that planning is so important with taxes, putting that into the plan for retirement, wouldn't you say?
Absolutely. So oftentimes, when we have a very efficient tax model built into a portfolio, an entire client's estate, what we can do is we can take substantially less risk and achieve the same results or better with substantially lower exposure to market volatility as well. So if we are more efficient tax-wise, we can end up with the same end result and just not have to worry about the volatility that we see in the market to the same extent.
Sounds great. Well, let's talk a little bit about how the environment has changed from where we were last year this time.
Well, first of all, and I know we were talking earlier about the CARES Act, for example, right? So we've seen this massive stimulus come into play here, this massive amount of government funding and intervention. And typically, I'm not a big fan of the government, intervening in our private lives. I'm very into letting them live our lives. But what they've done was necessary to make sure that we avoided this catastrophe and we're mitigating the effects of it. But with all of the stimulus money, the PPP, all the other programs that have come into play, someone's got to pay for that. That's not just free money. We're, yes, they have the unlimited ability to print that money. But remember, someone has to pay for it. And how are they going to do that? I'm guessing by raising taxes in the future, right? So, I'm a big fan of trickle-down economics, but the reality is, it can't trickle down that much, right? Someone's going to have to pay the bill, and that's being, completely exacerbated by the fact that with these market declines that some people have seen, people are scared. Now, people that were going to retire this year, maybe they decide, no, we're going to push it off a couple years, or maybe it actually accelerates them, because a lot of people are furloughed right now, and they're saying, you know what, this ain't so bad right now, So just remember what we've seen. Historically, we knew the day of the baby boomer retiring was coming. But the Congressional Budget Office in 2008 showed some projections about what that could look like and how it could affect Social Security and some of our other, budget issues. And the reality is this, that may be coming a lot sooner than was planned for. And that's going to put a massive strain. Imagine this massive workforce leaving the workforce, moving into retirement. They're going from, adding to the budget to now depending on the budget, right? So there's a massive shift there. And I think there's some opportunities here that we need to plan for in the very near future to really be able to take advantage of where we are.
Well, can you tell me a little bit more about, we touched a little bit on the CARES Act. Tell me a little bit, because a lot of us have questions about it, because it's something new. Give me a little bit more information about that and how that's going to work for us.
Well, one of the things that I think could help you is there were some provisions in the CARES Act that actually allow people that are under 59 and a half to withdraw from their 401ks without any penalties. Now, you still have tax issues and so forth. But what you're also allowed to do now is roll over a portion of that 401k money to an IRA before the age of 59 and a half. So the concern here for a lot of people with 401ks is, they've depended on their own expertise for the last 20 years.
Yes.
And it's been fine, right? We've had this amazing decade in the market. They thought they were, their own Warren Buffetts here at home, by picking the S&P 500 index, all that. They've done well. Well, just remember, a blind chicken could pick a good stock here over the last decade, right? And with all due respect to you at home. But the reality is that now we're in this really rough time. The seas are rough now, and now people are realizing, man, you know what? I was just enjoying the ride. Right. What do they say? Rising tides float all boats, right? Yeah. And everyone does well when the market does well. But now what we're seeing is people that realize, man, you know what? This is not the right place for me. I should not be making these decisions. And we're starting to see a lot of interest in people looking for professional money management to oversee their portfolios, their 401ks and so forth. And we're seeing a much younger client come in now to do that as well.
Well, Stewart, I think this would be a great time for us to open up the phone lines. The number's 833-652-7829. Stewart, you're going to offer the first 10 callers a complimentary portfolio review. Is that correct?
That's right. Yeah, for the first 10 callers that call in, we're going to offer a complimentary portfolio review. That's normally a $1,500 value. And if the first 10 call, we're more than happy to help.
We're going to take a short break, but we'll be right back.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Thanks for joining us again. I'm here with Stewart Willis of Asset Preservation, Tax, and Retirement. How are you, Stewart?
Good, and that's a mouthful, isn't it?
It is. I'm getting it out there, though. Stewart, before the break, we were talking a lot about taxes and things that go with those. Tell me, what tax opportunities were you talking about that people could be taking advantage of right now and in retirement? Right.
So what we've seen is this decrease with, with the Trump Tax Act. We've seen this really amazing middle class tax break. And, take all the politics aside, whether you're a fan of Trump or you don't like Trump, the reality is that America is saving on taxes right now. Most of America is. It's not just catered towards the ultra wealthy. And if you are not taking advantage of where we are right now, you're really missing the boat. And the problem is most advisors don't have a tax office built in, right? They'll come on the radio or TV and talk about saving taxes because they've read a book that says they'll do it that way. What we do is actually show real cash flow models to play out not just today or next year, but your entire lifetime. What would happen? For example, there's the ability to convert to Roth. Roth is a retirement plan that basically allows you to pay the taxes now, then you never pay taxes again, even when you withdraw the money. So all the growth is tax-free as well. Well, what we do is we look to see if it really does benefit you specifically, not because your friend has one, not because your neighbor told you to go do it, but whether it really makes sense for you to do it or not. And people think it does. What we do is we actually create a complete cash flow model to show you whether or not it makes sense for you. And a lot of advisors, they don't stay away from it just because they don't have a tax office and know the answers. It's also because, think of it like this. Imagine you're at the 24% tax bracket and an advisor has a $100 million book of business that he manages, and he all of a sudden converts 100% of his clients to Roth. Well, he's just created, remember, the tax bill has to be paid. Right? It's coming from somewhere, and oftentimes it comes from the assets that they manage. So what you end up seeing is a 24% reduction in the overall assets that advisor's managing, and that then turns into lower revenue for the advisors. So oftentimes when you don't have that real fiduciary commitment, it's very easy to say, hey, you know what? Let's keep you inside an IRA or a 401k, because what happens when you have money in an IRA, people never end up using it. They're so scared to pay the tax bill that they never actually get to enjoy their retirement. And I think to me, that's the worst part of saving is, the saddest part of my job is when I see the client that's 82 years old, his spouse has passed away, they've saved all this money, and they just say, man, I wish we would have taken that trip. I wish we would have done this. I wish we would have done that. I have all this money and I never got to enjoy it. And so what we try to do is first find out what plans does that client have? What is it they really want to accomplish? Let's create a plan to accomplish every single one of them so that you know that, hey, if your goal is to pass $1 million to the kids, or $1 to the kids, or nothing to the kids, you want your last dollar, your last breath to end at the same time, whatever, it's my job to accomplish that, right? And once you know that those have been taken care of definitively, then it's time to start enjoying life, taking those
Yes.
trips, enjoying your life, really squeezing the marrow out of life and having a great time.
Yeah. Well, it's planning for a lifestyle as well. You're planning someone's retirement, but it's their lifestyle that you're trying to maintain. And you're right. People plan and save their whole lives, but they need to enjoy their life.
No doubt about it. And we live in a retirement community here, where our office is right in the center of Sun City, the retirement capital of America here. And people like to have fun.
Oh,
I think they're just scared sometimes that they're going to run out, and we will show them a cash flow model of whether or not they will. Don't get me wrong. Sometimes I tell people, no, you cannot retire at 59 years old or 62 or 65. You need to work for another 2 years, because it's a lot more difficult to retire and then re-enter the workforce later.
Yes.
Right?
Yes. Very much so. Well, let's take a minute, and I've been to your website. It's very well done. Tell our viewers how they can get to your website and what they can expect once they get there. Yeah, so at www.apsitaxes.com, you can find our website. There's tons of great information on there. There will eventually be some links to some of the other things. We've been so busy with our planning here. Over the last couple of years, we do these huge workshops, and we'll have 75, 80, 100 people in there, and what we're seeing is just a massive flood of people coming in now who thought it was a good fit, and at the time they liked us, but it wasn't quite good for them then. But now they're saying, you know what, with this market volatility, we need to make a change. Are you still doing meetings within the office, mostly virtual meetings? How's that working for your business at this point? Well, first of all, we do an amazing job at sanitizing the office. I've been a clean freak my whole life. It's a little bit of a problem, I guess, with my wife, but I don't think so. I can tell you this, it didn't pass off to my kids. My son's room is a disaster, so it doesn't help him, but he didn't catch what I have. But we take every step we can to sanitize the office. We have, everyone jokes about our big bottles of hand sanitizer every step of the way. We sanitize between each clients. We honor social distancing, but we also do have Zoom conferencing, teleconferencing available for anybody who decides that that's the medium they want to use. And I'm sure you're good at that, because if you're living in Arizona, you're getting some snowbirds there that probably go back to where they live maybe in another time of the year. Yeah. So those virtual meetings are probably not anything that you haven't done before. Yeah, no, you know what? It's actually interesting. The one benefit that the whole COVID scenario has brought to us is made us shift technology even into a stronger position. So we now have clients in Canada that would spend actually more than half the year there. And now it's very easy to communicate back and forth. So a lot of our snowbirds, even from Canada, are feeling a little more comfortable because we like to see each other's face, Right. I'm a really personal person. I'm a big fan of doing business with people that you're comfortable with, and you have to like them, you have to feel comfortable with them. Oh, definitely. And I just say, look, if you go into somebody's office and you say, you know what, I don't think this is right, it's just time to go and find somebody that is. And even if that's me being, the person you're not comfortable with, find somebody that you are. Well, Stewart, again, we're going to open up the phone lines. We had a lot of calls earlier, and they're still coming in, so be patient. You will get through. The number is 833-652-7829. Stewart, do you want to tell our viewers what the the first 10 callers will get? Sure, absolutely. That Portfolio X-ray that we're going to offer will take a look at all of the fees associated with any portfolio item you have. It's best to bring everything in just so that we can do a complete analysis of every single thing that's there. We can look at the fees, any sort of hidden fees that are in there, expenses, etc., and performance. I mean, performance matters. And what is the tax efficiency, right? We want to see what kind of financial implications are down the road, and we'll do a very cursory tax view of what's going on as well. But I think people need to know how are they performing, what could they have done differently, and what can we do in the future? Again, the number is 833-652-7829. We'll be back in just a bit.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just a downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
So glad you could join us again. I'm here with Stewart Willis of Asset Preservation, Tax, and Retirement. How are you, Stewart?
I survived the break.
Yes, you did. I did too. I think we'll just move right along, right? Before we were at break, we actually finished up talking about some tax opportunities and some things of that nature. I'd like to throw some words at you that I hear all of the time, as well as a lot of our viewers do, my friends, family do, and have you explain what they mean. It's jargon, it's financial jargon, and they're big words, some of them, and we'd kind of like
to know. Is this
like
Jeopardy here?
Kinda. Let's see how good you are. Yeah, you can do it. Okay. The first one is asset allocation. What can you tell me about that? What's it mean, and what does it mean to your clients?
Yeah, so asset allocation is actually pretty simple. What it means is basically how are your assets, the investments that are in your underlying portfolio, how are they allocated? Where are they placed? What are you invested in? And typical asset allocation models will vary based on what your risk tolerance is. Historically, the sort of static asset models will use more bonds than stocks. Well, we're entering a really crazy time right now, and I know I'm riffing a little bit more and I'm expounding on that.
No, that's what I want you to do.
But the reality is that some of those classic models may not work the way they once did. We are in the lowest interest rate environment in history. So some of those bond portfolios that have historically been the safe place for assets may not be quite as safe, meaning today, the 10-year Treasury is in the 0.7, 0.8% range. So you're going to invest for 10 years to make 0.7% a year in a bond. Now, understand when that interest rate rises, right, around us, and now bonds are paying 2%, 3%, but you're holding on to bonds that are paying 0.6%, there's going to be some pressure on the value of that bond depending on the duration of it. So it's not quite as safe as it once was. There are additional risks that didn't exist before, in my opinion. So we've gone to other models to look at to create that safety.
Okay. I've got another one for you.
There we go.
Risk tolerance.
Well, risk tolerance is just the client's ability to take a loss, and that's a lot. People don't like talking about loss, and don't get me wrong. I have clients that have said, "Look, I'm pretty aggressive here," and you know what, this COVID drop around them, and these are clients that weren't just clients of ours, but clients that had come up from the outside, and we weren't really the right fit. We were a more protected, defensive company for them, and they'd come back and say, look, I really wasn't as aggressive as I thought. With a 30% decline in the market, I can't take that.
Right.
Everybody sounds aggressive until it's time to see those losses.
See what happens.
Yeah.
Right? Yeah. How about, now we've heard this word a lot, and I know there have been changes with this, so maybe if you could expound upon that, that would be great. RMDs.
So required minimum distributions are distributions that are required to be taken out of your IRAs, 401ks, deferred comp, 457s, all of those once you're done working, or you achieve what used to be 70 and a half, now it's 72. The IRS has basically said, look, you've put away all this money tax deferred your whole life, but at 72 now, because of the Secure Act, you're now required to take out that money and pay taxes on it. So what ends up happening happening is you have this massive tax time bomb that is finally being, revealed to you here, and it exposes your entire tax profile to a taxable income stream.
Now, you kind of forget when you're putting all that money into that 401k, eventually you're going to have to pay the taxes.
Yep.
The IRS is going to get their chunk.
That's it. And like I said earlier, we don't believe those taxes are going down anytime soon. So sometimes it's best to have a real plan to really have an RMD strategy. And we do that with our cash flow modeling.
Here's another one for you. Basis points. What does that mean?
Well, basis points are a little confusing to most people. So if you say 25 basis points, that's 1/4 of 1%. So 100 basis points is 1%. 50 basis points is 0.5%.
Okay.
So people, oftentimes a lot of advisors will use very complicated jargon to confuse you, to lose you in the conversation. So
that's why I wanted to ask you these questions.
Right, just so that they don't have to explain it, right? Basis points, I think, is also a way to confuse people in terms of fees.
Okay.
So when you say, hey, I'm charging you 150 basis points, it's a very fair fee. People don't realize that's 1.5%.
Right.
So those fees start to add up.
Okay. All right. Thanks for explaining that, because I didn't know what that was.
No problem.
Small cap, mid cap, and large cap. We'll have to go through these kind of quickly, though.
Yeah, well, small cap are companies, quickly, they're smaller companies. Mid cap are companies between the mid cap, between the small cap and the large cap.
Okay.
Large cap are just bigger companies, the big Fortune 500 companies.
Okay. And then what about ETF?
So exchange-traded funds are what ETFs are. Now, ETFs are amazing. ETFs have really changed the landscape of most really advanced financial planners. Most people have gotten away from mutual funds. Now, there's some alternatives that still make sense, but ETFs are just super efficient. There's been some recent tax rulings that make them way more tax favorable for non-qualified accounts. So it's a really effective, inexpensive way to invest, especially when you have your own money managers like we do.
Who do those work better for, the ETFs? Which clients of yours?
I think they work better for everybody. Okay. So if you have a professional money manager, an ETF works well for the client, because if you have an average of 0.2%, or in your basis points analogy, 20 basis points versus 1.5% for a mutual fund, what would you rather have? Yeah,
there you go. Well, you know what I'd rather have. Well, it's been wonderful talking with you, Stewart. We're going to open the phone lines up again, 833-652-7829. Please give us a call. Again, Stewart's going to offer you a complimentary portfolio review. Please give us a call. Thanks again for joining us, Stewart. Have a great day, and it was a pleasure being with you. See you next time.